Hi, my name is Simon Quattrocchi. I'm from GV Finance Brokers, and I've put this little pod series together to give you information about what the finance industry is about and how to go about some of the home loans that are available to you. So I hope you enjoy this podcast series.
Welcome back to episode 6, and this is the final episode in this series of the GV Finance Brokers podcast. Today we are talking refinancing and debt consolidation, and of course we have Simon here with us. Welcome to the episode.
No problem. Thanks, Anthony.
So, obviously, at the time of recording, we have interest rates that have increased significantly, but obviously the information that we'll talk about in this episode is going to be relevant no matter what the interest rate is. At the moment, though, there is an interest rate cliff that everybody is talking about. Rising interest rates that have been really occurring over the last 12 months, essentially. Basically, the fastest on record. Let's touch on that.
Yeah, so certainly over the last 12 months, we've seen a significant increase. So we went from 0.1 and now we're at 4.1. So that's quite a jump in a 12-month period of time. And obviously they've been trying to increase those interests as the cash reserve rate to try and curve inflation. Yes, which is probably not curved as quickly as they would like it to have curved down. So that's right. So we've got unfortunately for individuals out there, we've got pressure not only from the interest rate hikes that they're incurring. You also have the inflationary pressure that is happening with just the general cost of living. Correct. And those two combinations are not quite very, very good. And you just mentioned, the fixed rate cliff that's starting to occur, and certainly clients are coming in for it constantly now. You're going up from a low rate, maybe I've had one was 1.89, so it's a pretty low rate. And the rate that was offered was over 7%. So that's a fairly significant increase in a repayment to try and get used to straight away. Exactly.
Yeah, personally, we had a fixed rate 1.99, and now we're on a variable, and it is upwards of 5.5%. So it makes a big difference inside of 12 months. That's for sure.
Yes.
All right. So let's talk about refinancing. Obviously, cost of living pressures, interest rate rises. There is pressure on the mortgage. There's less disposable income. So in terms of refinancing, what are some of the reasons why we might look to refinance?
Well, there's many reasons you can look to refinancing. One is obviously coming off fixed rates, and you might be going into a higher variable rate that your current lender is offering. So there's that factor, and you're trying to at least shave, at least maybe 1% off, or even more off. The other part is that you could be actually on a higher variable rate, and you want a lower variable rate. Yes. So that's two reasons in regards to just straight refinancing to lower the rate. Other reasons is that they might not be factors for your decision. It might be that you're looking to renovate, do a minor renovation. You need $100,000 out to do your renovations. Yep. You could be looking to buy another car, a caravan, or any, in the term the banks use, is a worthwhile purpose. Yes, sure. So you could be getting money out just for that purpose. Yep. The other reason is we touched on debt consolidation as well. So you could have your home loan, you might have a car loan, you might have a personal loan. And believe me, I have come across this. So 4 or 5 credit cards, the buy now, pay later, and all those payments do stretch the budget. So you could end up having outgoings of about $4,000 a month, and you might be able to consolidate, and it might become $3,000 a month. Sure. And that'll put another $1,000 back into the family income to cover your everyday normal expenses.
As well as consolidating some interest rates, maybe some monthly fees, etc., and so forth. So it all adds up.
Yeah, it does all add up. And the other one is that investment. People are refinancing to go buy that investment property. Yeah. Now that one's slowed a little bit, and that's market, and I think that's a little bit of a concern about taxes that are being implemented now. What a government's doing. Do I want to deal with a renter? Is it better to go Airbnb? So there's a lot of factors in that. So that's become a little bit more of an interesting market as well.
When we are talking about the Reserve Bank increasing interest rates, and with the current rate at the time of recording being 4.1%, it actually can make it more challenging to refinance as the interest rate increases.
Correct.
So talk to us about that. Why is that the case, that as the interest rate increases, just refinancing for whatever purpose may become more difficult?
This is where it gets a little bit trickier, especially with if you just want to refinance your current home loan. So at the moment, and it is slowly changing, say the offer that you got is, we'll just go call it an even 6%, right? What happens is that a buffer is applied to that of 3%. So when the bank goes to calculate your actual repayment, they're calculating on a rate of 9%.
Sure.
Plus the higher HEMS or living expenses that they're calculating. It could be for a couple or couple of children, whichever it may be. That all those combined living expenses and higher thresholds for your repayment technically could make it what the bank sees as that home loan unaffordable. Even though you could have been making those repayments for the last 12 months without a problems whatsoever, it's kind of clients will say it, and I don't blame them, say a little bit nuts to that. How are you telling me I can't afford this home loan when I only want you to refinance this home loan, and I've got no problem making these repayments?
Sure.
And it's hard to explain to a client, well, this is the reason, this is what they apply. And this is APRA applying this and making the banks do this.
Sure.
So, and the banks do have a responsible lending guidelines as well. So they obviously want to apply a buffer. But what they're doing now is a couple of lenders, and I'm sure other lenders will follow, is they've reduced that buffer from 3% to 1%. So if you don't quite meet the capacity under the 3%, if you've got good repayment history for the last 12 months, then they'll apply the 1%.
Sure.
But there are, you cannot involve mortgage insurance. There's a few, you've got to meet some of the criteria in there. But at least they've now actually providing that opportunity to be able to change over.
For sure. And it would be easy for people to get caught out with that 3% buffer, because you see the interest rates being advertised on the variable loans or the fixed rate loans, but you're not factoring in the extra 3% on top of that when you may be using some of the repayment calculators, so it could definitely catch you out.
Yep. And the banks don't actually put that on their calculators.
Sure.
So when they go to check their capacity, it tells them they can afford the loan, but even their own calculators don't actually factor that buffer in.
Yeah, right.
Which they should.
Yes, interesting point. Then, so in terms of the additional challenges to refinance, we've spoken about the fact that there is that 3% buffer, depending on the how well you've been servicing your loan over that time. That might be reduced to a 1% buffer. For instance, if, for example, there has been a blemish on the record, perhaps there's been a missed payment, does that impact your ability to get finance? And if so, what kind of impact does it have?
Well, at this point in time, the impact is that if you've missed that payment, it won't make you eligible for that 1% buffer.
Sure.
Because what they're trying to do is they're trying to, in a sense, mitigate the reason they're not using that 3% buffer, right?
Of course.
So what they're trying to say is we're going to disregard that and use the 1% buffer, but for us to do that, you have to have shown that you haven't been having any issues making those repayments.
Of course.
Otherwise, they're taking on a debt which has had a form of arrears or issues, and that doesn't quite fit the guidelines of how it would be viewed as responsible lending.
Sure.
So, yeah, don't miss a payment. That's
very important.
That's all I can say. And that's hard now with everything going on and trying to budget around that. That is very challenging now.
Again, just another point for making sure that you're managing your finances and staying on top of things. In terms of consolidating debt, we have already kind of touched on this, but just in regards to consolidating other debt outside of a home loan, can we just clarify for everybody, what other debt might be, again, in terms of, is it credit cards, is it personal loans?
Yeah, so as long as it's personal, it doesn't matter generally what type of debt it is. So, for example, we had one earlier in the year where we did actually have a car loan, 2 credit cards from memory, and there was actually a family loan of $30,000 in there as well.
Sure.
So we wrote it up the notes, and that was fine. There was no issues in regards to that, as long as it all can be justified.
Sure.
And it all makes sense. Business debt Generally not. Most banks will stay away from it unless it's a small debt. They might consider it. And then there's also sometimes they tend to shy away from tax debt.
Yeah.
But there are always ways around things, basically. So, so as long as it's considered personal, not for business use, you're usually pretty right to consolidate that.
Fantastic.
But the buffer rule stays.
Still applies.
Yeah.
Correct. Let's touch on cash out for renovations. Refinancing, we want to work on some renovations. Perhaps it's a car or some other kind of quote-unquote asset. But when we're talking about renovations and refinancing, how do we go about that?
That's easy. As long as you've got the equity and you've got the capacity to afford the loan, it does depend on the lender. So that always comes into it. So, for example, we've got, not that I've actually had to do it, but we've got one lender, as long as it doesn't fall above 80%, they've got a $1 million cash out rule.
Sure.
Don't know what you're going to do with $1 million in cash, but anyway. Whereas most of them hang around the $100,000. We just did a cash out for $150,000 for renovations, all minor, might add, and it was only to do a kitchen, a shared, a shared bathroom, redoing the carpets, and a bit of painting and whatever, and it added up real quick, and they listed it all as well. Wow. It's all becoming very expensive now.
Very costly.
So, 150,000 doesn't seem to get you very far now.
Doesn't go as far as it used to, no, for sure. You touched on 80% there. So in terms, again, another important note, if we are looking to, again, tap into the equity, cash out for renovations or whatever other purpose, again, that 80% in terms of the
It's not a hard and fast rule, though.
Not a hard and fast rule, okay.
Some lenders will go above 80, up to 90%.
Yep.
What will tend to happen is, because a mortgage insurer is involved, the bank might ask for you do become a lot more limited on the cash out component of it.
Sure.
The lender won't necessarily want to control the funds, but what they'll say is, now some will just say list it all for you, no problem, and they probably won't have an issue with that as long as they consider a fairly strong client, or they'll just say, look, have you got all the quotes that you want to put, so we can see what you're doing.
Yep.
And if you put that in, they'll say, well, here's your money, basically.
Okay.
So it just means might have to do a little bit more work than just writing a list or just saying I need $100,000 out for a renovation.
Of course. Yeah, exactly. And just to clarify for people as well, when we're talking cash out of a loan, that involves increasing the loan amount as well.
On your current loan balance.
Correct.
And not actually physical cash. It goes into your bank account.
Exactly. All right, let's touch on investment properties. So refinancing for investment properties.
Yeah, so this one's can be a little bit more common. We do have clients that have a good rate and tend to, when we refinance them, that rate may be very, very similar. What happens is that with investment properties, it does vary quite significantly from lender to lender on. Say you got $1,000, I'll just use an easy figure, $1,000 in a rent per month. One lender might use 900 of that. One lender might only use 700 of that. So they actually shade it.
Okay.
So, and then they contribute the expenses towards it very, very differently.
Sure.
So it could be, and it depends on your income as well. So this is where it can vary. And this is why sometimes I'm not always of the view that we have to refinance that loan. So you might have a loan with ABC, offers a very good rate. Now, if I can make that fit and the interest rate with that lender is quite good, all we're doing then most likely is just using the equity towards that purchase.
Sure.
Okay? But look, 80% of the time it does require restructuring.
Yeah.
Because sometimes, the client might only have 10 years left on the loan, but with that 10 years, trying to factor those repayments and buying a $450,000 or $500,000 investment, it does require a little bit restructuring to make it fit for the client.
Yeah, of course. And when you mentioned shading the rental income there, that's kind of like the inverse of the 3% buffer, isn't it?
Exactly right. Yes. So the buffer goes the other way
correct.
as well.
Yeah.
So you could imagine how it gets tougher and tougher to buy an investment property, and this is having an effect on the market as well. So you can imagine you've got maybe a $500,000 investment loan being buffered as well at 9%. So And then you've also got whatever rent may be coming in, and that's been buffered negatively. So in between that, you have the lowered rent income, the higher actual repayment, which could be a difference of $2,000 maybe.
Yes,
It
yes.
adds up real quick.
Yes.
In which you need to demonstrate that you've got that excess surplus from your actual income.
Correct.
So that's where it takes a little bit of tweaking, and that's why I say sometimes it requires a refinance because we've got to try and make that work
Yes.
for the client to be able to make the purchase.
Yeah, and also I just keep referring back to the point of anybody who's doing their own research online, or they're trying to figure it out themselves. When you're looking at interest rates, rental income, using calculators, you're not going to have the exact figures. You might be able to sort of work out a scenario where you can cover everything, your serviceability is fine, but you're not factoring in these buffers, the shading, and all the other things that may just throw it all out of whack.
Correct.
Yeah.
So, and that policy is not available online, so
Of course.
you just can't find it.
All the more reason to contact a good broker like yourself and let them handle all the grunt work.
That is right.
Yeah, fantastic. Excellent. I think, have we covered off on everything for refinancing?
I think we have. I don't think there's much else in there. No, I believe we did. I think we covered up that quite nicely.
Excellent. Well, Simon, thanks very much for all the information across the episodes in this series. Lots of information, and again, it just pays to talk to the professionals and talk to somebody who is in the industry and can really assist you to get the best possible results. Thanks for your time on this series, Simon, and we'll talk to you soon.
No problem. Thanks, Anthony. Thank you for listening to the GV Finance podcast. New episodes will be live each month, so stay tuned for up-to-date information about all things finance. Please subscribe on your preferred podcast platform and share on your social media channels.